Right. So today's topic is life insurance planning for high net worth clients. Today we'll go through high net worth case studies showing the use and value of life insurance. Some of them are actual client situations that I've been involved directly with. All of them are viable strategies where life insurance helped or can help secure the outcome at hand. Life insurance is simply a financial tool, a tool providing leverage and liquidity. It offers unique benefits, including power of contract, tax deferred growth, tax free proceeds if owned properly for estate planning purposes, and protection from creditors in many states. High net worth clients use life insurance for estate planning. They use it to secure the transition of their business, to avoid a liquidation sale on their assets, to enhance their legacy to family or charities, and of course, to pay their estate taxes. Estate planning and estate tax planning require different thinking. The axioms of estate tax planning tell us it's not what you make that matters, it's what they keep that matters. It tells us don't die the richest guy or girl in the graveyard. Gift assets, shrink assets, freeze assets, and leverage assets. You want to minimize your bad assets to die with and maximize the good assets to die with. You see, in general, at a high level, the estate tax laws require us to contribute to society if you've been successful to a certain point and beyond. And so your social capital can be the tax that you pay for estate taxes. And of course, you are allowed to avoid estate taxes legally with a lot of maneuvering, which we'll cover, and benefit organizations and charities that you care more about. So throughout the presentation, we'll give some more insight to that. So estate planning specialists will tell you that there's two estate tax systems, one for the informed taxpayer and one for the uninformed taxpayer. The less you know, the more the IRS takes. But hold on, knowledge itself isn't power, right? It's the application of this knowledge. So the reality is the less you do, the more the IRS will take. And so a comprehensive estate plan for persons with large estates must incorporate one or more of these strategies. You use techniques to reduce or shift the value of assets. Implement programs that take advantage of income, gift, and estate tax deductions for transfer or transfers to charity. You leverage cash gifts through the purchase of life insurance held in ILITs. If I may use a football analogy, since it's football season, we're trying to get from one end zone to the other. On the left, we have max tax with no planning and, of course, no say in your social capital. On the other end zone, we get to self-directed social capital, where you avoid tax by involving charities, churches, and foundations that you might create. But it's a lot of work to get from one end zone to the other. You have to develop living trusts and power of attorneys and healthcare power of attorneys. Pick out your guardians, trustees, executors. You want to be making lifetime gifts. You might utilize irrevocable life insurance trust, spousal lifetime access trust. You might purchase life insurance. You'll use qualified personal residence trusts or sales to intentionally defective grantor trusts. You might utilize family limited partnerships, family LLCs, grantor retained annuity trusts, private split dollar, premium financing, and lots of attorney fees. But here we are, we're in the red zone of no tax, and all we have to do from here is give away our excess wealth to charity, whether it's charitable gifts, charitable lead trusts, charitable remainder trusts, and family foundations. This is the work to get from one max tax to the other end zone of no tax, and not very many people get there. So just quickly, in the state of Illinois, and we'll address other states in a minute, but state of Illinois is one of those states that has an estate tax still. So even though your client might not be federally exposed, there are a number of states, about a quarter of them, that still have some type of tax when you die. We'll be showing that in a few minutes. But just a quick thing, what do you do in football if you want to score fast and big? You throw the bomb or the Hail Mary as it goes. And so sometimes, even though people look like they won't have any exposure, because in Illinois, the estate tax starts at $4 million. And so if proper planning is done, a husband and wife under $8 million might avoid all tax, right? Federal and state estate tax. In John and Mary's case, though, John has a large IRA of 3 million bucks. And so if he were to die first, she's likely not able to use that for John's 4 million exemption. She's going to roll that over. And that's where sometimes things aren't as they appear. It matters how the assets are registered and what you're going to do with them at the first death. And so what we explained to John and Mary simply was that they had a lot of, they were already making gifts to their church and they plan on leaving it. So we showed, hey, buy some second to die life insurance. After the first death, you can put the IRA beneficiary as your church. And we'll be addressing how IRA money is taxed in a short while, but in John and Mary's case, it would benefit the church for the balance of the IRA, and they're replacing the value of the IRA to the kids by buying the life insurance. So people don't always need life insurance, but sometimes they need liquidity, and there's a cost of liquidity. When you think about it, how many people keep a lot of cash on hand? You have an opportunity cost when you have too much cash on hand. And even if you had enough cash to pay any estate liquidity charges, you have no leverage there. You're spending a dollar to pay a dollar. When you borrow, who's going to lend? What's going to be the lending rate? How will you pay it back? And when you do pay it back, you're paying a dollar plus interest on the dollar. So you're spending more than a dollar of tax if you have to borrow to pay the tax over time. If you have to sell something, sometimes you have to sell it quickly to come up with the taxes due because they're due after the second death in a married couple situation, 9 months afterwards, with some exemptions to that. But you don't want to fire sale the assets that you have. And so a quick sidebar, the former Miami Dolphin owner, Joe Robbie, he ended up with a $110 million estate after the second death, and only about $30 million made it down to the kids because they had to fire sale the football organization and other assets. And what's interesting that I like to bring up about him is that before he was a real estate and franchise owner and mogul, if you will, he was a tax attorney. So he knew these things, but he did either denial, he can't claim ignorance, or he ignored or thought that he'd handle it later, perhaps. So that's why insuring life insurance provides the leverage cash with timely delivery and a known outcome, and often the cost is pennies on the dollar. And that's why you see people utilize life insurance with their estate planning situations. It's simple, easy, a known outcome. There's tax deferred growth in the policy. The policy proceeds are received income tax free. If we own it properly outside the estate, then it'll be estate tax free, provides tax diversity, and may be the most economical way to pay your estate taxes. There's also protection from creditors and predators with certain states and life insurance. So the current laws as we know them, the exemption went up on us instead of down. They were set to sunset at the first of next year and go down to around 7 million, but we now know what they are, at least for this set of laws. Remember, I've personally been around a long time, and there's been a lot of different sets of estate tax laws along the way. And you hear a lot of people wanting to tax the rich, and so they might change again. So it's hard to plan when we have a moving target, right? And that's the challenge. But right now, federally speaking, a husband and a wife If they set things up properly, they can avoid any estate tax from the federal government if they're under $30 million. And the top tax rate is 40%. They can use annual exclusion gifting at 19,000 per person. And the bottom line is that many people are going to not have a federal estate tax under these laws. The bar has been moved up. But there are a number of states, the ones in yellow on the picture here, still have an estate tax within them. So if you're planning with clients in these states, it's something to be aware of. There's a few states that have an inheritance tax. Those are the ones in green. And a couple of states have both an inheritance and an estate tax, and those are primarily Maryland and the District of Columbia. So when you're in these states, it's important to think about things and how you're planning for the estate tax situation and the liquidity that may be needed on those for that situation. And so, how do they come to estate taxes? It's everything you own minus what you owe plus your life insurance proceeds. That's what comes up to your taxable estate. And so, one of the estate tax axioms is to gift and leverage, and that's what you're doing when you own life insurance. So let's get into our case studies. We're going to look at how to eliminate estate tax in some situations, removing life insurance from the estate, gifting and leveraging with life insurance, carve out situations, and we'll address the worst asset to die with, which is qualified money. So Ruth is an Illinois resident. She's a high net worth individual worth about $5.5 million. She wanted some more supplemental steady income. She wants to maximize what she leaves behind, and she knows that she's exposed to estate taxes in Illinois, not federally. And she had significant non-qualified assets available on hand. And so this is the design of what we did. We took $1 million, and excuse me, I said $5.5 million. She's worth $4.5 million, excuse me. We took $1 million of her money and we bought a lifetime income annuity. And what that does is the day after we annuitize the money, from an estate tax perspective for the state of Illinois, her estate now is not 4.5 million, it's 3.5 million. Now the SPIA is going to kick off 72,000 gross and net her 66,000 after taxes each year. And we're not disinheriting the kids. She's buying $1 million guaranteed life insurance policy in an ILET. And that premium's $23,000. That gives her $43,000 a year of excess spendable money. And she has now accomplished the fact that her net worth the day after the transactions are in place is only $3.5 million. Now, I want to emphasize here on the low left corner, you see life only. We don't want any contingencies on the lifetime income because the present value of that would come back in the estate and it could kick her back over 4 million. You see, in Illinois, they're so bad that if you're a dollar over 4 million, they tax you from $1. So what we've educated her on is that you want to make gifts along the way. If you're accumulating money and your net worth is growing again, make gifts and see the kids and grandkids enjoy that money during your life. And in this case, we were able to eliminate the estate tax for the state of Illinois. Our next case is getting life insurance out of the taxable estate. And when you see client chronicles, these are actual situations I've been directly involved with the clients with. And in fact, Keith is a longtime advisor that I've worked with, and he is very successful in his practice. And he asked me to review his variable life insurance policies that he bought a long time ago. He was already max funding his 401ks in earlier years. He still needed life insurance protection, and he started funding variable life policies. But along the way, he stopped funding them, and he wanted to see how they were going, where they were going to go to. And we ended up getting the policies out of his estate with a two-step prong, which I'll address in a second here. But he no longer was focused on income replacement. He himself was a high net worth individual in the state of Illinois. So he doesn't have federal tax exposure today, but he does have state of Illinois tax. So what we did on the left-hand side, we looked at the projections of his variable life policies at 0 and a 6% net. And at 6%, one of the policies was going to have a bigger problem way down the road. Of course, he could earn more in there, but that's how they were projected. But the problem was they were in his taxable estate. And they were policies on both him and the wife. And so you can't 1035 a policy, two individual policies in the second to die. So we used a 10-year only SPIA. We took the $173,000 of net cash value and we bought a 10-year SPIA on each one of them. The combined income was 19.5 per year. Net of taxes, they were going to have 17,600 a year coming in. And on the right-hand side, they're kicking in roughly $3,000 a year over the next 10 years to fund $1 million second to die policy that's held in an irrevocable life insurance trust. So in this case, neither of them have died yet, so we don't know the return, but this is a guaranteed contract. And so if year 30, the second death occurs, the net return for this transaction was 6.3%, rolling over the cash value into annuities and funding the policy over 10 years. So in their case, we were able to replace underperforming VUL policies, eliminated estate tax exposure from the state of Illinois on their life insurance. We increased their death benefit from the combined two individual policies into the second to die for $1 million, and we replaced projected insurance with guaranteed insurance. Our next example is gifting and leveraging. And here we're simply taking a look at two 65-year-olds and what they could do with $1 million gift to an islet that would own some life insurance for them. Now I'm projecting a 6% net rate of return. So on the right-hand side, they either can keep their money in their estate and grow it. And if they live a long time, they might outproduce the life insurance, is what we're showing here. But that money's in their taxable estate. If they gift the money to an irrevocable trust and grow it, they will avoid the estate tax, but they'll be at probably at the highest income tax rate because you get there in a trust with very little income. And the third option is gift and leverage the money via life insurance. And so if we just go 25 years out, the keep and grow is 2.5 million versus the 3.7 million death benefit. So we're certainly doing well there. But the gift and grow could potentially be larger. But the issue here is that we're showing a 6% net rate of return. And that's net of any taxes on the money, and that's net of any management fees. So you're really looking at an apple and an orange because we're comparing perhaps an 8 or higher gross rate of return with a guaranteed contract of life insurance. And so a little bit of a mismatch of risk versus return, but the numbers are where they are. And yes, given enough time, if the second death doesn't occur till 30 years when somebody's age 95, the gift and grow may actually certainly outproduce the life insurance. And that's the thing with looking at projections versus guarantees. The whole concept, again, not dying the richest guy or girl in the graveyard, is making gifts along the way. You don't have to keep and die with your full $15 million exemption. In fact, it's often better that you get growing assets out of your estate as far as minimizing estate tax planning, minimizing estate taxes goes. So only hindsight's 20/20, as we know. And again, if you want to fairly compare the life insurance versus the invest and grow, it's better to compare a fixed life insurance contract with bond alternative returns. And there is variable life insurance, right? We could fund it in there. And if we want to say the market was going to be great through the next 30 years, maybe they do better in that kind of a contract, but that's not a guaranteed contract in most situations, or the guarantees are inferior to true fixed life insurance. So sometimes it makes sense for estate tax planning and estate planning to carve out special situations. It might be a special needs child involved in the family. If we were to take a life insurance policy and put it into a special needs trust, we can take care of that special needs child. And now we can do regular estate planning for the rest of the estate and the other kids in the family. Sometimes there's special arrangements. We might have a kid that doesn't manage money well, or they have a drinking or drug or gambling problem, and we're worried about leaving them a lump sum. Maybe we carve out some money, leverage it with life insurance, and instead of the lump sum, have the life insurance pay an income over time instead of allowing the kid to access a lump sum of money that they might squander in situations. We use life insurance often as a wealth replacement. This was the John and Mary example. If they were going to leave their IRA to charity, we can make it up to the kids by taking some of that money out of the IRA along the way and funding life insurance to replace it. And then most often, for remarried situations, it's a lot easier to tell your new spouse that you're taking some of the money to buy life insurance so that you're going to leave them a lot of assets and you can leave the rest of your estate to the kids. Or you might reverse that. Perhaps you're going to leave the life insurance to the kids from your prior marriage, and you're going to leave a lot of the assets that might be commingled by now to your new spouse. So life insurance is the great equalizer, if you will. And again, a lot easier to take some premiums along the way versus taking millions at the end of the road to not scorn your new spouse so much. So there's the three worst assets to die with. First and foremost is qualified money. For those that do have federal estate tax exposure, there's double taxation, income and estate tax on it. And again, if you don't have federal estate tax, even state estate tax, along with the income tax, can shrink what's left behind in qualified money significantly. Non-qualified deferred annuities. They are, again, double taxed, but they have a basis. And then non-stepped up basis assets, things that you make gifts of during your life, maybe company stock and things like that, they'll have a carryover basis. So that's the third worst asset to die with. And so while I breathe for a second, it's a good time to remind you I'm neither an attorney nor an accountant, simply an insurance expert. And so certainly don't take this as tax advice. Check with your tax people or yourselves if you're in that space. And so let's focus in on qualified money, the worst asset to die with. We're going to take a look at a 65-year-old married couple who has $3 million in an IRA. And again, I'm showing a 6% net rate of return. And of course, if they're earning more, it'll grow more. Assuming a 35% income tax or income in respect of the decedent tax once they die, a maximum tax rates, and a 40% estate tax rate we're assuming. And we're looking at purchasing a $3 million second to die policy that would have a $45,000 annual premium. Now, what I want to keep in mind is that often what we hear from people who have large IRA balances and they don't necessarily need the money to live off of, a lot of times they're told to just let it sit there, don't take out anything until you are required to take out your RMDs. And that might be good income tax planning, but it might be bad estate tax planning. And so our first scenario here on the board has no estate taxes in it. Now we're just looking at this comparative with the income taxation of qualified money. Okay. So in 25 years, they're age 90. Their balance on the IRA has grown to 5 million. Yes, they took some money out for RMDs along the way. But when they die, there'll be $1.7 million in income taxes, leaving 3.2 million to the kids. Now, if we go back and say, hey, they don't wait until the RMDs are required. They buy that life insurance today. So they start taking out, and I'm grossing up, they're taking out more than 45, netting the income or paying income tax and netting the 45,000 to pay the insurance. They come out well ahead of the game. The kids end up getting 5.7 million instead of it. And so what I want to emphasize here is over those 25 years, they paid $1.1 million in premiums on the life insurance policy. But note what the difference is in their IRA balance. For the do nothing strategy, defer until you have to take RMDs, they have a 3.2 million balance versus the life insurance option 2.7. So we're not as far apart as you might think when we took $1.1 million out. And the reason for that is because we took money out early, we changed the trajectory of our RMDs later. We've kind of flattened the line of RMD trajectory, and that's why we end up with just a $500,000 balance difference, even though we took $1.1 million out to pay the insurance costs along the way. So with that, this is no estate taxes. Let's look at it. Excuse me, there is one thing else I want to go through on this one. One other thing, and going back to the John and Mary situation that I briefly mentioned, if these people had charitable intent, if they decided to leave the 4.2 million balance to a charity, then they would negate the $1.4 million in income taxes, and they'd have a balance of they'd have no balance there, but the kids would get $3 million from the life insurance, just 260,000 less than the do nothing option. So the idea of adding, what is the worst asset to die with is also the best asset to leave to charity is the bottom line. So if you have people who have charitable interests and stuff, it's important to go through. So I want to just pause. If you came in late, we need you to log 50 minutes, so please stay through the Q&A and log those minutes. Additionally, when you close out of today's presentation, a pop-up box will be there for a survey. At least fill in your CFP code or let us know if you're not a CFP, so we're not chasing you down. And we appreciate you filling in the full survey. If you have to run right after the hours up here, then tomorrow, 24 hours from now, you'll get another email reminding you to fill in the survey. Obviously, if you've done that and given us your code, you can ignore tomorrow. If you didn't have time to do it today, please do it tomorrow. And as well, there's a chat box if you want to add questions along the way. We'll answer all we can at the end. And my last little commercial here is that our next presentation and last for the year is December 17th, where we'll be discussing Life by Design. And that is taking a look at the different chassis of life insurance and the engines in life insurance and how it really works, looking under the hood, if you will. We'll give a little bit of history of life insurance in that as well. And if you'd like us to present to your firm or study group, please reach out. So moving on, let's go. We were $2.5 million ahead of the game with adding that life insurance policy is the long and short of it, and that's with no estate tax. When we add the estate tax now, right, we're still on the left-hand side. We grew to 5 million. We pay our IRD taxes. We pay our estate taxes. We net $1.9 million to the kids. And on the right-hand side, All things said and done, we end up with $4.6 million dollars because of the life insurance advantage. And again, if we look at the fact that what if we just donated that 4.2 million balance to charities that we care about, we would eliminate all those taxes and the kids would still be ahead of the game just receiving the 3 million out of the life insurance versus the 1.9 million from the do nothing strategy. So just wanted to cover that. Again, not fewer of our clients are going to have federal estate tax exposure unless they change the laws and lower those again in the future. And some are going to incur some state estate or inheritance taxes as well. So the tax might not be as high as the 35 or 40% we're presenting, but again, more shrinkage from the IRA account. So again, going with our axioms, minimize bad assets to die with because qualified money for very high net worth people is double taxed. Maximize good assets. Life insurance is something that's a good asset to die with, again, if it's owned outside our taxable estate. And what is the worst asset to die with is the best for charity. So should you be waiting for RMDs in some situations? We're working on several situations right now with large IRA balances where the people don't need the money to live off of. Nice problem to have, but now they're just tax traps and nightmares. And I don't know if you caught the article when the Stretch IRA was ended. Ed Slott came out with an article that discussed that life insurance is the new Stretch IRA. So we like his thinking being in the life insurance business here. So the second worst asset to die with is non-qualified annuities. Mike is a higher net worth client we worked with in Illinois. He didn't have federal estate taxes, but he had state estate tax exposure. And what we decided to do, because often people buy annuities and then they never annuitize them, right? They're primarily their income vehicles or their tax deferred vehicles. But if you don't annuitize it, you're just building up a tax thing. So he ended up annuitizing that account balance, getting $1,235 a month. And some of that $1,200 is not taxed for a long time because he had a $75,000 basis in the contract. And so this helps him minimize bad assets to die with. Moving to our second set of case studies, we're going to look at a Roth conversion alternative and how not to overfund qualified money, perhaps. We'll look at family business and the need for liquidity and how it changes there, and cover some of the advanced planning strategies that we might utilize out there. So I hear people all the time and understand the value of doing a Roth conversion. You're betting that taxes in the future are higher and that it's better to have these grow tax deferred and come out income tax free. The problem when we get to estate tax planning, though, is that the asset of the Roth IRA is still in your taxable estate. And so it's going to shrink. And so here's an example of somebody that was taken 100,000 a year each and every year for 10 years to recharacterize it to a Roth IRA. So we are showing a 6% net return. Now, because the Roth's growing income tax free and comes out income tax free, we're only grossing up for any management fee there, right? When we show the 6%. So long story short, the Roth IRA grows in 30 years to 4.4 million, but it's in the estate. And if it were estate taxed, it would shrink down to 2.6 million, and the 3.5 million life insurance already outside the estate, because instead of recharacterizing the 100,000 each year, we just made gifts of it to the ILET to fund this policy. So this is something to compare when we're doing estate tax planning versus income planning. Perhaps the life insurance leverage in the ILET makes more sense than the Roth conversion would. So begin with the end in mind is what Stephen Covey teaches us, and we're talking about these high balanced IRAs and how they can be an income tax problem and a state tax problem later. And so what if we think about it earlier and divert some of the money instead of overfunding the qualified resources down the road. What if we bought life insurance earlier? And this is an example of Dr. Slat. He was not only a very successful doctor, but he owned part of the firm that he was involved in. He already had a pretty large balance of IRA of 401k money, excuse me, and he had already owned some permanent life insurance. We were really there to talk about long-term care. Now, I know that a lot of people think that high net worth people, they don't even talk to them about long-term care. I understand they have the money to pay for care if they do, but again, it gets to accessing the money. And there's shrinkage. If you have to pull the money from your IRA, you have to pay income tax in between. If you have to sell a stock when the market's down, you realize losses. And so providing income tax-free money if you need care is something that some higher net worth people still find attractive. And often you'll find them even either buying life insurance with a rider or buying hybrids to take care of some long-term care exposure. In this case, Dr. Slat purchased $1 million guaranteed contract with a long-term care rider for both him and his spouse. We're just showing his premium here at 14.7, but he knew if I just keep putting overfunding my 401k, it's just going to be a bigger tax nightmare down the road. And he's still alive here. There's again a client chronicle that we were involved directly with the client on. We designed this to be paid up at age 65. And so all we're waiting for, he's not 65 yet. He's still in process of paying this. But once he has it paid up, the next question is, when does he die? If he dies 40 years down the road, it's a 4% net rate of return. Again, net of any management fee, net of any taxation, not a bad bond alternative. And if he needs care, then he can draw, because it's a spousal lifetime access trust, that accomplished getting the death benefit out of the taxable estate while still having access to the assets. So that's what Dr. Slat did. This is something to think about for your younger people, very high income, already max funding, they're qualified. Now, I don't want you to stop funding your qualified money. You at least want to get any matching from the company and stuff. But in some cases, maybe we don't give 20,000 a year, we give 10, and we start diverting to create this tax-free asset utilizing life insurance or set it up for long-term care. So we minimize bad assets to die with by taking some away from overfunding the 401k still. He gift and leveraged money. He owns it outside the estate in a slat. And he's got tax-free access if he needs care. And if he doesn't use it for care, it's there for legacy. And it provided some tax diversity. And of course, life insurance is an uncorrelated asset class. It's going to be $1 million whenever he dies or accesses it for care. So now when we get to the family business, things are a little bit more important perhaps for these people to have liquidity and life insurance. And so often if we take a situation like the 20 years from today, often the significant asset that a business owner has is the business, right? They can only dream of being in a position 20 years out where they've accumulated and half of their wealth is personal and half is business. It often just grows bigger and bigger as the today circle shows us. So what these people try to do, though, is they'll use family limited partnerships and family LLCs to start giving away some of the company stock to the next generation so that they, again, don't die the richest guy or girl in the graveyard is the long and short of it. But for them, it's even more important when you think about it, even if they did accomplish half personal assets and half business assets, how do they pay the tax man when they die, leave half of the assets, the business, to the kids that are in the business and then treat the other kids fairly through the personal. Again, it doesn't divide out often, unless all the kids are in the family business, perhaps, or they only have one kid, maybe it can work better. So this is where liquidity and life insurance might play a bigger role. Again, for business owners, they don't keep too much cash on hand. They want to reinvest it in the business and grow it. And then if you think about the founder of the business dying and the next generation taking over, they don't walk into the banker's office and get the same rates or opportunity to borrow and think about trying to borrow 50% of your net worth because you owe an estate tax when somebody dies. It may not happen and it's not as easy. And even if you can borrow, now you're paying taxes plus interest on the taxes if you're borrowing. I mentioned the Joe Robbie story earlier. Often you're trying not to sell the crown jewel or the family business within the empire, and therefore selling isn't an available option for you. So you only have cash borrowing or create and insure. And so just a sidebar here, with family businesses, a lot of times when we're working on continuity planning and such, these family businesses will buy term, they'll start with term insurance. They might buy some permanent now or intend to buy it later, but this is where it's very important for them to buy quality term insurance that keeps their flexibility and options open to get permanent later. Even if they sell the company, they'll often have an estate tax issue. And so the buying quality term gives them the right to get quality permanent later and no underwriting. So just a sidebar on the importance of what type of insurance they buy with it. I'm a fan of quality term across the board, but it's especially important with family businesses. So things can get very complicated when we're dealing with family businesses. Again, I'm neither an attorney nor an accountant, but this is actually a case that we've worked with here where we had two business owners that started with a cross purchase buy sell. Owner A owned the policy on B's life and vice versa. They decided to sell the business and they wanted to keep their coverage. And so we had to do a lot of things. First of all, you have to, whenever you're transferring life insurance policies, you have to be aware of the value of the policy as well as avoiding transfer for value. So ultimately, what we were trying to do was to get the policies now into an islet to use for their estate tax planning. And so we ended up cross giving, policy owner A. His policy went back to A, the insured. So now they own their own individual policies. Then we had to gift those policies outside to their irrevocable trust, or we sell them so we avoid the 3-year rule. And so along the way, in this specific case, we had to get valuations when we were transferring the policies back to each insured. Then we had to get valuations again when we were transferring to the irrevocable life insurance trust. And they ended up selling in one case because what happened here was one business owner along the way became terminally ill. Well, he wasn't terminal where he was going within 12 months, but 5 years into this contract, he had a life-stricken disease that shortened his life substantially. He died about 7 years later, and we paid out about $18 million on his insurance. But through the transactions here, we were able to get those policies into an irrevocable life insurance trust so that that insurance wasn't estate taxed as well once he passed away. So that's how complicated it can get, and it's things that we're very versed in along the way. So when you have no lifetime gifts remaining, when you're certainly very high net worth people, you try to freeze estate assets, reduce them, and get them out of your taxable estate. So strategies like premium finance and private split dollar might be things that you've heard about before. And these are strategies we're very capable of utilizing and implementing when it's appropriate. Whenever you're dealing with premium finance situations or private split dollar situations, people use them because they're cash flow poor and asset rich, or they have fewer or no exemptions remaining. They're already maximizing their annual exclusions. They might have given away their lifetime exemptions, is the point. Sometimes they'll use these strategies as an opportunity cost. I'm not going to take cash flow out of my business. I will borrow the money from somebody else to buy the life insurance that I need. And there are times when they use these strategies as an arbitrage play. If I can borrow at 3 and make 5, I'm 2% ahead of the game, if you will. But rule number one with either of these strategies is you need to have an exit strategy when you're entering these kind of arrangements. And there's certainly some abuse, especially in the premium finance arena out there. There have been some abuse out there, no doubt, and we avoid those things. So, what do you do for your high net worth client discussions? Well, be aware that the estate tax laws may change again. Create your team of advisors. Get a good estate tax planning attorney. Get an accountant that understands estate tax planning. Consider working with us, if you will, because we're very well versed in these usage of insurance for high net worth clients. But have conversations with them. Start exploring strategies, some that you may have seen today, and discuss those. Decide if they make sense and document the conversations one way or the other. It isn't necessarily about, pushing to buy insurance. It's consider it. And while you're still healthy and understand where the value proposition comes in by owning it now and later in your life. I understand, and I've been around a long time. A lot of people think about term and invest the difference, or they think that I don't need insurance later because I have all these assets. But I like to use the word value in place of need. And I often find that people, as they age, as their health it deteriorates, they have more regret that they didn't own some life insurance than they do that they, never bought permanent to start with. But life insurance has value with or without estate taxes. Hopefully, we've shown that today. Life insurance is simply a tool. It's a leverage tool. It's a liquidity tool and used for lots of different situations. And it's a plan that works and can be a valuable asset to own. So we will be sending a recording of this presentation to you. I'm going to get to the questions in a minute. If you still have some questions, add them to the chat box. I remind you again, please fill in when you close out of today's presentation. Please fill in the survey if you give us some insight of what else you'd like to hear. If you'd like us to speak at your firm or study group, please let us know. But we'll include these resources as well in the kit to you. Some information on ILETs and understanding the uses of trust and understanding the estate tax laws out there for the states that do have them. And here's a picture of my mug for you. And thank you for attending today, one way or the other. But again, log in for the full 50 minutes here. If you've come in late, please stay on during some of the Q&A. And let me start taking a look at some of the questions here. So, is the ILET including death benefit and cash value? Yes. I'm not sure where your question came from, but once we put a policy in an ILET, both the death benefit and the cash value would be contained within there. A lot of the insurance that I was showing you was guaranteed universal life, which doesn't necessarily build up a lot of cash value, but consider it, if you will, permanent term. I hope that answers your question. Let me see. I thought IRAs were outside estate tax with beneficiaries. No, an IRA is in your taxable estate. And when you die, the value of the IRA comes up. The beneficiary role is just saying who gets it. Beneficiaries trump any of your estate planning documents, if you will. So if you have, and then the same thing with life insurance. If I have my brother on my life insurance as primary beneficiary, it's going to go to him irrespective of what my living trust said, where I wanted everything to go to my wife. And I'd say the same thing with the IRA beneficiaries. So it doesn't avoid estate tax, but it directs where the money goes to. Power of contract, if you will, and the beneficiary arrangement. Um, Lots of good questions here, all from the same person. So I will answer them because they're good for insight here. And if you want to have a one-on-one, we can certainly talk about things more. But IRD is income in respect of the decedent, and essentially, whoever is inheriting my IRA is the one that's going to pay the tax. It's a little bit of semantics, one way or the other, if you will. But if you inherit $1 million, you're going to owe tax on $1 million, and we call it an IRD tax. So it'll immediately put you in the highest tax bracket if you get $1 million on it. But still, the asset is in my estate for estate tax purposes. So income and estate tax planning are different things, to be clear. Um, if you take money out of your IRA to buy life insurance, are we not taxed? You are absolutely taxed on it. Once you pull money out of an IRA, it's income taxable money. So in the examples that I've shown you, we are netting out. So I didn't show all the numbers and all the columns for the IRA example that I gave, but that $45,000 premium that they were paying, we did gross that up, and I'm not sure of the number here, but we were taking 60 something out of the IRA, paying our income tax to net the 45 to pay the life premium. So we did account for it in that transaction. So again, I did show you the life insurance cost that was on the setup of the case design where we were buying $3 million of life insurance with that $45,000 premium. And I did also recognize that after 25 years, we've spent the million one or whatever on the compute on the few on the total life insurance premiums up to that point. Um, Yes, you're again, if you wait till you have RMDs exposed, you're not taking them out net of you're not taking them out and saving the income tax. Whenever you pull a dollar out of your IRA or 401k, you're going to pay tax on it, and you're going to have to pay the tax and gift the net of that to your irrevocable trust. And all good questions here. And the Dr. Slat example, they're asking if I pull money out for long-term care, does it reduce the life insurance death benefit? Absolutely. It's a dollar for dollar reduction because we have a true rider on that policy. So um, I know today is high net worth and life insurance conversation, but I'll make the statement to you that I believe the future of long-term care is life insurance with a long-term care rider. The younger people are, the more that's true. If you wait till you're in your 60s, a lot of those people are buying hybrids more so than they'll buy. Fewer and fewer people are buying traditional long-term care these days. And so, that's something to think about. Don't, if you're a high income person and you're max funding your 401k, maybe it makes sense to not as heavily fund the 401k and use some for life insurance. And you see that there's value to be able to utilize that. I understand you might have wealth when you retire, but I also understand it's not what you make that matters, it's what you keep. And that's where you have the shrinkage from pulling out a qualified or selling stocks at the wrong time and such. Um, this one, you're welcome on your last question here, but this one I have to digest. Curious about the strategy of moving IRA to a SPIA to pay for an ILET. So if this is the Keith and Kathy, well, no, we didn't, that wasn't an IRA, that was life insurance, but this could have been the Ruth situation, if you will, that if she had little non-qualified money and we decided to annuitize 1 million of her IRA money, then the full again, we wouldn't be moving the lump sum of IRA money to the ILET. We would annuitize it and then use the net of that income each year to fund the life insurance policy inside of there. If we did that, you're both welcome on those questions. So I'm staying on for 4 more minutes to round out the hour. If you have more questions, I'll answer them. I do want to emphasize that if you came in late, please stay on till the end here to log your full 50 minutes so we can give you the hour credit. We do need to do that properly. So again, thank you for taking time to learn with us today. Please do reach out if you have any specific situations that you want to discuss.